Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. This week, my guest is Jonathan Nichols. Jonathan, if you want to start off by just letting everybody know who you are, and then we'll have a chat.
Absolutely. Well, first of all, thanks for having me, Glenn. Excited to be here. My name's Jonathan Nichols. My wife, Paula, and I are real estate investors local to the Dallas-Fort Worth area of Texas. We began our investing journey about 7 or 8 years ago doing single family. Started just buying that on the side while we worked our W-2 jobs for a few years. And we basically bought a small portfolio of single family rentals that we still own and use for short-term rentals here in Arlington, Texas. But then a couple of years after that, wanted to start something that could be a full-time business that we could scale. And so pivoted over to the world of multifamily syndication, which is how our company Apogee Capital was born. And since then, we've syndicated about 8 deals across various markets in Texas and Oklahoma. And we're now both full-time investors doing multifamily. So that's the short and sweet.
That's awesome. Before we get into this, I'm kind of curious. How did you come up with that name, Apogee?
Yeah, it's a great question. So my career in my former life was working as an aerospace engineer. And in aerospace engineering, apogee is a term that, like, if you're calculating like satellites orbiting or a spacecraft orbiting, it's like the furthest point in the orbit that something can reach. So it's an important term to know. Well, in the dictionary, the more like colloquial, definition of it is like reaching the peak or apex of something. And so, apogee kind of represents my past career, combining that with what we're trying to do now, which is helping investors reach their financial potential.
Awesome. All right. Well, there is like a million different things to talk about, because you just talked about single family and multifamily and and syndication and single, it's a little bit of the entire spectrum. So you know what, I'm going to start you off with a question, but you talked about it growing and getting bigger. What did you find from doing the single family that's helped with doing multifamily, or doing, what kind of things did you learn, or things that you could take from doing the single family to doing the syndication?
Yeah, that's a good question. I know a lot of the gurus out there will say you don't have to do single family. You can just go straight to multi. And that might be true, but one thing I've always pitched to my investors is I paid the dumb tax early on with my own money on the single family projects, right? Under budgeting a CapEx project, or finding a bad tenant for a property, or whatever the case may be. All those little mistakes that can cost a lot of money, I got to go through those early on my own without anyone else's funds involved. And so I think that's probably the biggest thing. Really the biggest reason that we pivoted, I would say, from single family to multifamily is that there's a lot of things in single family that just didn't really fit our skill sets. So I already mentioned my background as an engineer. My wife's background was working as a consultant. And so things like running numbers, managing projects, hiring people, implementing business plans, we can do stuff like that. Yeah. Things like, yelling at the contractor to show up time, or going to scrape the popcorn after they don't show up, or, finding a tenant or asking them to pay on time. That's not really our cup of tea, right? Yeah, and so by pivoting over to the commercial world, I would say it was more of a change to something that was within our skill sets as much as it was, taking what we had learned and translating it.
Okay. That makes a lot of sense. And well, for me, I do both as well. And just being that far away from my properties, for me, I just don't have the option.
Yeah. Yeah.
There's no way. And I was honestly one of the first things when I first started investing. My first property was in Alabama, and one of the reasons it was so far away that there's no way I'm going there, because I used to have properties in my backyard and I'd go fix it myself.
Yeah, that could be a blessing in disguise, right? I would have to say I lived a little bit too close to my single family portfolio, but today I don't really do much of that. So we've figured it out. It just took a little bit of time.
Yeah. So, even when we were talking briefly before we started doing this, we were talking about underwriting, or even just doing analysis on a deal. how has that changed, like from doing a single family to doing a multifamily? And maybe I guess we kind of have to like maybe before actually scrap that question. Before we start into that, like what like let's sort of define like what kind of stuff you were doing. So when you're doing the single family, was it just like buy and holds? And when you're doing the multifamily, like there's even multiple strategies on that. Are they like the big value adds? Are they new
Yeah.
construction or like or light value add? Like there's a lot of different ways to do it. And honestly, there isn't a wrong answer to this. Like there,
Yeah. So our niche in single family was, sort of a pseudo BRRRR strategy, but then on the back end using it for short-term rental as opposed to long-term. We did some regular long-term rentals and it just wasn't our cup of tea. And where we live, right by the stadiums, it pretty lucrative when you were buying properties a few years ago at the basis you could get them at then, combined with a low interest rate. You combine that with the income you get on STR, and it really made a lot of sense. So it probably what your audience would be familiar with is BRRRR strategy. We bought most of our stuff off of MLS. Paula is a licensed agent, so we could get contracts out on stuff really quickly. So no super, savvy wholesaling off market type of strategy. Just looked at a lot of properties and bought what made sense. Went in, did a renovation to get it up to the standards people would expect. Early on, we did a lot of refinances on those properties. Today, we don't. So we have to find a debt product that we're happy sticking with for a while, just with where the markets are today. But early on, did a lot of refis, pulled out a lot of cash, and just kind of ran with it. So that was the single family side. On the multifamily, we really started out doing what I would call like light value add. So it's very difficult going into multifamily to get the kind of returns that investors want without having some kind of value add in the business plan. Like if you're just buying cookie cutter turnkey deal, you're probably not going to get the returns that investors want. And so you got to have something, but we would do more like light upgrade renovations that have already been proven out, or adding, proven amenity fees, those kinds of things. And then we pivoted a little bit this last year. About a year ago, we bought our first ever heavy value add deal, which we bought in Lubbock, Texas from mom and pop owners. They'd had it for 35 years, untouched, 69% occupied, decently well taken care of, but like no management structure. And we literally moved to Lubbock to work alongside our third party property manager for about 3 months until we got the deal turned around and stabilized. So I know that's a long-winded story. We've done a little bit of everything, but that kind of gives you a flavor for some of the different projects.
Yeah, no, there's so much to that. And so what was the date, kind of like even approximately the purchase date for the Lubbock, Texas one?
We closed on July 19th of last year.
Okay. So
yeah, not
how did you are you still working on that then? I'm guessing the renovation is still on the go.
Yeah, I mean it's a 5-year hold, and I would say 18 months to get the initial renovation and stuff done. We're now 93% occupied on that property, so it's running pretty well. The kicker is like with where the debt markets are today on heavy value add in like tertiary markets. The bridge loans you get on those deals are like 10%, which means your break-even occupancy is like 90%, which any of your listeners familiar with multifamily are like, wow, that's high. And it is.
Yeah.
And so there's a lot more risk. And that's why, we literally just moved there for like 3 months till it was turned around. And like, there was no leaving it to chance. It was like, we're going to figure this out. Even though we have, third-party management and all that good stuff. But so I'd say we've finished 75% of the work, both in terms of CapEx dollars and in terms of just effort level. But we're continuing to do stuff every month. A few residents leave, we renovate those units, turn them.
Yeah.
So it's an ongoing thing, but the riskiest, toughest part of it is complete.
So you mentioned bridge financing. Did you go into bridge or you go straight into like HUD? Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
We start out with bridge, right? So with HUD, this is a 70s build product. So like it's really tough to get HUD. So most of our long-term financings agencies, so like Freddie or Fannie, is probably what we'll go to once we get out of the bridge loan, which probably later this year sometime. We'll see where rates go. Right now, we're kind of sitting here with our fingers crossed. We'd like to see it go a little lower because that would juice the cash flow ongoing on the deal. But we'll see.
Did you guys buy a rate cap for like the future refinance?
Yeah, and I mean it's not. Everyone talks about the rate caps. If you buy it where the numbers make sense at 10% interest, like it's not a huge deal or an expensive deal. It's when you thought rates were going to be 4% and they went to 10%, and you have to buy it back down to that. Is when you hear all these heinous stories about like $1 million rate caps and stuff. So it was really a non-issue for us on our business plan. But it's because we were able to buy the property at such a low basis. So just to give you an idea, we've been looking for a deal in this submarket for about 3 years. In 21 or 2022, deals were trading in 70s a door for C plus assets in this submarket. The highest one sold for about 82 a door that we've noticed. We bought ours for 49 a door.
That's really cheap.
So that gives you an idea of like, yeah, the interest rate sucks, but like that's why we did it, was because the basis was just incredible.
Well, yeah, no, like Dallas, when we were looking at that, it was 100 plus. So yeah,
exactly.
So, no, it sounds good. And the reason I was asking about that is exactly, you answered that question perfectly. I was started like, when people are talking, that's why I asked about timelines. I'm like, people who bought 2 years ago and didn't buy rate caps are in a situation. Exactly like you were talking about. And for people who are listening to this and we're kind of like talking in terms and it might go over their head a little bit, but even like, what did you say you bought it at occupancy 65% or something like that?
I think we closed at 69. So, but mind you, this is a 170 unit property. So, going up 20% on occupancy, you're talking about like 35 to 40 net leases. And we have people moving out too during that time, right? Like you have organic turnover. So I think total we signed about 60 leases from the time of closing to year end, if my memory's right. That's a lot of leases.
Yeah. No, and that's honestly probably too why you got the discount that you did get. Is because, if you're at 69% occupancy, apply that, figure out your net operating income based on the cap rate, you're going to be paying a discounted rate because it's just places isn't full. Right, because based on how much you're actually making, so exactly. It's about finding an opportunity in all of this. So did you find it when you're trying to raise on those kind of things? Just from my personal experience, if you're doing a really heavy value add or a really low occupancy, I found in this kind of market, people are kind of scared to and they're looking for like the safer investments. And whereas like 2 years ago when the market was flying, they were way open to the riskier, higher big money projects.
Yeah. No. So, I mean, I would be lying if I said anything other than you're exactly right. That's exactly what we found. The rate, this is as underwritten, the best project that we've ever done. And it was still probably the toughest one to raise for. We did one other syndication deal that we raised for last year.
Yeah.
And it was more the light value add, and it was marginally easier. It was still hard. And a lot of it is just, investors right now are very skittish. If they invested during that, COVID to 22 timeframe, they may have LP deals that are struggling. And so that definitely chases people away. And they also probably don't have funds coming out of those deals with profits that they can reinvest, which kind of slows the momentum of money from investors. We're pretty fortunate on our GP portfolio. We don't have any deals that are in distress like that. Like we haven't made any capital calls or had any deals foreclosed. And so we've been pretty fortunate that our investor base is, largely been sheltered, at least if they've only invested with us, has been sheltered from that. But as a whole, it's really affected the LP investment pool, I would say. And so, Yeah, people are skittish about tertiary markets. They're skittish about C class, particularly 70s build, where you're talking about cast iron sewer lines and, maybe older roofs and all kinds of those things that they're concerned about, combined with a bridge loan at very high interest rate, needing a rate cap. So those are just kind of a few of the considerations or concerns that I've seen people have.
Yeah, it sounds like you've addressed them well too. Like when we're currently like been looking at properties and putting some under contract in Texas as well. And yeah, we've been looking at more of the new stuff, lighter value add, and stuff that like cash flows right from day one.
Yeah.
Which has changed. Like just the way we look at stuff has changed because it has to, if you something we can even go right into agency debt right off the start so that we're like, we know that the investors are going to be okay, right? Because that's the biggest thing. Like, if you buy a single family house, because we both came from that sort of world, and even if you take on a joint venture or a private prom note or whatever, if stuff goes out of whack, you can throw in some of your own money and fix it.
Yeah.
When you're talking about like, I didn't even do the math to figure that building out, but you're like talking $16-20 million kind of buildings that's what we were looking at. And when you're looking at those kind of prices, like, if things aren't done 100% perfect off the start, sometimes it's too much to fix later. It's too hard to fix the whole thing.
Yeah.
I have more free content. So if you're interested, I created a PDF guide and a video to go along with the PDF guide to complement it. And what the guide is all about is the 5 most common mistakes that Canadians make when investing in the United States. So if you're interested in this free guide, go to CanadianInvestingInTheUSA.com/mistakes. And let's go back to the podcast. And it's free.
Yeah, and that's really where the buying opportunity today is, right? Is you have, I've seen sellers, forget about bridge debt. I've seen sellers on fixed rate debt where they're even offering like a loan assumption and they're trying to get out because they're out of CapEx funds. They're not running the property well. And unlike times past where you had the tailwind of cap rate compression, rent growth to kind of shield you and just let you, you could exit at year 2 or 3 instead of 5, still make money for your investors and look like a hero. You can't do that right now. And so you really got to run a tight ship on operations if you want to see your business plan all the way through successfully.
Yeah, no, and that just comes down to the underwriting and just being conservative on all this stuff and like you just said, not mismanaging it, being like a micromanager almost off the start, at least to get this thing rolling and set expectations for the whole team. No, this is a great conversation. Mind you, I don't know. We've been talking a lot of like larger multifamily or at least mid-sized multifamily, and it might go over the heads of some of the listeners because I know that a lot of people are into the single family homes, and so it's a little trickier to sometimes keep people entertained with when we're talking about this sort of stuff. Yeah, I don't know. Arlington. So, oh no, you're looking at Lubbock, but you're living in Arlington. So why Lubbock? What do you love about Lubbock? Like every time I'm looking at different markets, there's always something different that's awesome.
So I'd say the verdict's still out on Lubbock. I mean, it's a good market. There's some people who are really successful there. We've historically invested in a lot of tertiary markets like Lubbock. So like we own an asset in College Station. We own in Abilene. We own in Tulsa and OKC in Oklahoma.
Yeah.
And the reason we target a lot of those markets is, back when prices were pretty inflated, we could get things at a better cap rate, cash flowing day one, in our mind, less risk, fixed rate debt. So like all our old stuff has fixed rate debt. So we're not worried about, loan terms coming due and all that stuff. So it's definitely a strategy that worked well for us. And so Lubbock just kind of fits some of the criteria that we look for. It's got about a 300,000 MSA, employment, job growth, huge thing that we look for. We've had a lot of luck investing in university towns, which, Lubbock is home to Texas Tech, one of the state schools. We don't do student housing, but just when you look at employers, you'll be talking to investors and say you have like a Walmart distribution center or an Amazon distribution center, or like we have one property that has like a Google data center by it, right?
Yep.
any one of those companies could, in theory, pick up 1 year and go somewhere. And that would have a very negative impact on the local economy, right? So, one, you want to look for diverse groups of jobs. You're not relying on one employer. But when it comes to schools, one thing I can guarantee you is that Texas Tech is not going anywhere. Texas A&M, which we own another property, not going anywhere, right?
Yeah.
And those schools provide a lot of jobs to the local economy. And so it kind of fits in with our thesis of buying in diverse job areas. And the other thing that we look for in more like the submarkets is really good economics of the families, particularly the median household income. So we want the average family, at minimum, the average family to be able to afford to live at our place, right? Which usually means that they make 3 times whatever the monthly rent is in their gross income. And most of our properties greatly exceed that threshold if you look at the numbers. And so that kind of reduces your delinquency, or, people who are not paying, increases your occupancy because you have more qualified people to choose from. It's just a better way to run properties, in my opinion.
Yeah, no, I totally agree, because you don't want it too close. Otherwise it just, you're not necessarily getting paid first. So yeah. Anyway, Jonathan, this was fun. People are like, Apogee, what is this? Where do I find it? Tell us about your company. Tell us how to find it. And people that want to reach out to you, let's give them some contact information.
Yeah, absolutely. You probably see on my little logo behind me, but we have our website up there, apogeemfc.com. So feel free to check out our website. We got
spell that for them.
Yeah, sure. It's APOGEEMFC, like multifamilycapital.com. We got all kinds of resources out there, and you can reach out and contact us there too.
That's awesome. Jonathan, I really appreciate you coming on the show. This was a lot of fun, and I'll have to have you come back in 6 months or something, man.
Yeah, let's do it, Glenn.
That was a nice video. Bye.